Hello, everyone. Today on the final bar, my guest is Bob Lang from Explosive Options. We're going to talk about the new volatility regime. Volatility, in the form of the VIX, had been sort of in a muted mode for a little bit, but all of a sudden rounding right back to the upside, exploding higher today as the market moves very much back into risk off mode. We talked yesterday and the day before about this rotation from growth into value that now has become a more rotation more from risk on to risk off. Today, I would argue the exclamation point for that thesis. We'll look at all the charts together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the action of the markets through technical analysis, focusing on the message of the markets themselves. One of my mentors, Ralph Eckenpora, would always say, if you had one thing to understand the markets, to understand the S&P 500, get a chart of the S&P 500, just the prices, and focus on the price. You cannot restate price. You can restate earnings. You can restate a lot of things. You can't restate price. That happened. That is fact. So focus on the message of the markets. That tells you everything you need to know about investor sentiment, supply and demand, all of that. So with that in mind, what does a day like today tell you? Well, certainly, less demand than we've had in previous days. Certainly plenty of acceleration to the downside, led by some of those growthy sectors like consumer discretionary and technology. But it wasn't just focused there. The next two from the bottom, materials and industrials. This is a widespread movement, which is something we've been talking about. For a little while, it was growth or value over growth. Now it's starting to deteriorate a little more into risk management and risk assessment. And we have a lot of great guests on this show coming through. Bob Lang in a little bit is going to share his thoughts on the NASDAQ and focusing on the message there. We have other great guests coming along on Thursday, the 13th. We have Chris Brecher from Brecher Trading. Next week, we have two great guests to mention. On Tuesday, the 18th, Joe Rabel from Rabel Stock Research. He's one of the frequent guest hosts of Your Daily Five. And also Katie Stockton from Fairlead Strategies is going to be joining us on Thursday, the May 20th. Coming back to the market recap, so very much in distribution mode. There's no better way, I think, to describe the action that we've seen today. And if you're surprised by this, you either haven't been watching our show, or you haven't been paying attention, or haven't been, I would argue, looking at a lot of the clear signs that there are distributive patterns in place, right? And it started in January and February with bearish divergences on things like semiconductors, on the movement lower on the ARK Innovation Fund and most stocks that are held in that fund, things like Peloton and others, and Zoom kind of coming back to earth after exponential rises. Then there's this consolidation phase, and most recently it's been sort of the value-y stuff still kind of working. Things like financials and energy and industrials and materials, things like Freeport-McMoRan still making new all-time highs while the growth trade was struggling. What we're seeing on a day like today is, I think, the risk to the overall market conditions, which is the downtrend in technology, the selling pressure in something like tech and the other growthy areas of the market are so severe that industrials and energy and stuff holding up is not enough to keep the market to the upside, right? For a while, we've had the S&P sort of choppy, flat to up a little bit while growth has been underperforming value. Now, all of a sudden, we get everything rolling over. And the question is, now what? And I think at this point, based on some of the evidence we're going to look at, I'm certainly thinking more in risk management mode. I would encourage you to be thinking about your positions, your holdings, your where you're at, and be defining where is that risk. If you have not already, hopefully you've done it when the market's making all-time highs. That's the best time to be planning for an emergency. But as we're seeing distribution, I would be looking for opportunities where you would need to lighten up, where you need to raise cash based on what you're seeing. Let's look at as many charts as we can here as part of the recap. The S&P down just over 2% is one of the worst days we've seen in quite a while. The NASDAQ down almost 3%. with the NASDAQ composite down about 2.2%, nearing the 13,000 level. This is from the NASDAQ composite coming off of just above 14,000 not too long ago. Mid caps and small caps feeling the pain even more, with the S&P 600, the small cap index, down 3.2%. The VIX, by the way, is nearing 28. This is after being about 10 points lower, is in the sort of upper teens a couple of weeks ago. And all of a sudden you're seeing this rotate right back higher and accelerate back to the upside. Very quickly on some of the other asset classes, if you're using interest rates as a gauge of market concerns, a flight to concerns about inflation and things like that, you certainly got validated today with the 10-year yields going higher. Yesterday it was down around 160. Today it's getting up nearing 170. So continuing to move back to the upside as bonds are selling off. The dollar, by the way, up. This is one of the better days we've seen from the dollar index in quite a while, with the UUP up about 0.75%. Gold and precious metals are actually down today. So, in general, we've talked about the strength in gold, and yesterday was a nice move to the upside. But the conditions are a little challenged on gold. On my YouTube channel, by the way, if you go to Market Misbehaviors, the channel on YouTube, I recorded a video just yesterday focusing on the movement in gold and how it's become overbought, sort of hit that upper extreme. And I think the potential to pull back is very real. I think we're seeing the beginning of that today. Overall, I think structurally it's still in a decent uptrend along with the broader commodity complex. But check out that video if you want more color there. So cryptocurrencies are an interesting one. Bitcoin down about over 4% today, around 54,350. Ethereum and others down as well. And I think this is a real sort of philosophical moment for cryptocurrencies, right? Is this an opportunity? If the market corrects, if stocks start not working, if bonds are not working, if gold starts coming off, the question is, where do you go? This could be a really good opportunity for something like Bitcoin to be a store of value, to be a safe haven, to be a repository where people ride things out. I'm not getting that vibe on a day like today. I'm getting it more as a risk asset. And on a day like today, when stocks are selling off and people are panicking, Bitcoin is driven by speculation at this point, and it being down like this is basically people hitting the panic button, just like they are on technology stocks today. So overall, I think its ability to differentiate from other asset classes is not comforting if you're looking at today as any example of that. Let's go through some of the other markets here very quickly as much as we can get to. So, when we're looking at a chart of the S&P 500, the line in the sand has now been breached. It was traded below intraday yesterday. Today, we've actually just plunged right through that 4120 level. We've been talking about this for a couple of weeks, that, as long as the market keeps making higher highs and higher lows, the trend is up. When it stops making higher highs and stops making higher lows and flips lower, that's the indication, according to Charles Dow, that the trend is no longer up. I think the early warning on this move that we've seen is what we've talked about: the higher highs in April, the lower peaks in momentum, this bearish momentum divergence, very reminiscent of what we saw in January with the S&P going to new highs, but the momentum going down. Now, that only resulted in about a 4 to 5% correction, just under 5%. Bringing the S&P down to its 50-day moving average. Don't look now, we're about there. If you take the high from a couple of days ago to where we're at, we've already retraced just about 4.5 to 5% off of those all-time highs. So, if this is a garden variety correction for 2021, we've kind of done it, and we've hit the 50-day moving average, or very, very close to it. We're also hitting a trend line from these lows, the October low, the March low, and where we're at. Would not be surprised to see a bit of a bounce, especially after the down move that you saw today. That would be fairly reasonable. But I think violating that level here through the remainder of this week would be a very interesting tell. You see these shaded areas, which would be my downside objectives, given a break below that trend line. And the moment that happens, if it happens tomorrow, we will be talking about downside objectives, what that might mean for different stocks. But a lot of names have gone ugly, especially in the growth areas. We break that level, and I think you'll start to see a lot more selling pressure come in to the point that's unsustainable. I mean, in terms of the ability of the market to repel that sort of distribution would be unsustainable, and most likely you have more of an extended correction. A 10% move, by the way, will get us down near this purple area around 3850 to 3900. So that might be the next logical place. Very quickly, we're going to talk later in a segment banking on breadth. We'll talk in particular about breadth conditions. So I don't want to get too deep into that just yet. I'd love to focus on just some of the other patterns and things to focus on. You know, it's interesting looking at this basket of stocks, sort of this growthy basket. Things like Peloton. Peloton down today, but actually outperformed the S&P today. It was only down 1.8%. And getting a bit of a bounce here. And what's interesting on the chart of Peloton, it's like the ARK Innovation Fund. You're getting this rally, this short-term rally out of oversold conditions. You can see that happened back here in March when it hit the 200-day and bounced higher. Similar oversold condition. We're seeing another similar oversold condition. Here's the thing, though. What I'm seeing on the chart of Peloton is I'm drawn to the longer-term trend of lower highs and lower lows. I'm seeing the downtrend. I'm seeing this short-term bounce as a short-term bounce. I'm seeing it as a tactical rally within a long-term downtrend. I'm more concerned about the fact that this has now validated a head and shoulders top with the head at the top, the left shoulder, the right shoulder breaking the neckline, and that measures a lot lower than what we've seen so far. We've talked about the ARK Innovation Fund, and not to continue to drive home. It's just such a great way of capturing all of the names that you'd want to look at. The ARKK has also broken down through its 200-day, broken down through price support. I think this measures a lot lower than where we're at. We're at that oversold level almost. And so expecting a bit of a bounce here as the market digests that, totally fair. However, I'm drawn to a pattern of lower highs and lower lows, especially the lower highs. As it's tried to rally, those rallies have been met with resistance and the 50-day moving average. So overall, it certainly feels as if the path of least resistance is lower. We need to take a quick commercial break. Back with my guest, Bob Lang. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. As a reminder, we'll do another mailbag segment on Friday's show, and we'd love to answer one of your questions on the air. Shoot us an email. thefinalbar@stockcharts.com is where you can reach us. We're also on Twitter @FinalBarSCTV. We're on our YouTube channel. Just put a comment below the video that you're watching. We'll capture all those questions and hope to answer one of your questions in our next mailbag segment on Friday. Also, as a reminder, the new StockCharts TV on demand is ready for you. It is free. All you need to do is go to StockChartsTV.com, use your email address, set up a free account. You can start watching all of our great content with our wonderful hosts, our guests like Bob Lang and many others that do such a great job of putting days like this into perspective. So you can go to StockChartsTV.com. Also, we're on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest today, joining us once again on the show, Bob Lang. Bob's the Chief Options Analyst at Explosive Options, coming to us from New England. Bob, welcome back to the show. Thanks for coming on today.
Thank you, David. It's great to be with you again.
So it's always fun to come on a show when you have a day like this, when it's carnage in a lot of ways. You had obviously a big distribution day, and besides energy, most things sort of down in a fairly significant way. The volatility conditions have certainly been evolving real time. This is the chart updated through yesterday's close. Talk us through what you're seeing.
So Dave, when in your intro, you talked about distribution being the big D word. I'm going to say there's another big D word going on here, and it's called denial. And why I say denial is if you can just roll back two days ago, back to Monday, and what did we have? We had a lot of distribution going on. If you looked underneath the hood, the internals and the indicators were awful. Yet we saw the Dow Industrials was up. We're up at new all-time highs. Didn't we hit 35,000 on Monday? Gosh, it seems so long ago, right? 2 days ago.
A lifetime ago, right?
Right. But and I think the problem here that we have with this market, Dave, is that people looking for places to hide. Right. They see a lot of the distribution happening, certainly been happening in the NASDAQ, which we'll take a look at that chart in a few moments. We've seen that in the NASDAQ here for the past month and a half. And it's well, where am I going to park my money? Is it in Caterpillar? Is it in Goldman Sachs or JP Morgan? Or is it in McDonald's or something like that. And of course, I'm spouting off the Dow Industrials because that's been the strong index. But for the past 2 days, I mean, what have we lost 1,000 points now in the Dow? I mean, and nobody's blinked at that. It's amazing, right? Nobody's really paying any attention to that.
That's exactly right. Now with volatility, obviously it's spiked up now in the last 24 hours up to the 27, 28 range.
Yep.
Where does that end, or where do you look for reference points as to where we should expect volatility to be going?
Well, I'll tell you what, I just I don't really look at the VIX as part of as being a target, Dave. Rather, I look at it just in terms of an indicator and telling me, where's the temperature of the market right now, and where is it a fever or is it ice cold? And for right now, I'm telling you right now, it's a fever. And I'm not going to say the prescription for the fever is more cowbell, but sorry, that was a bad reference there. But I can tell you that the VIX having closed at this level here, we could certainly spike up again tomorrow or the next couple of days. And let me tell you something. If you thought that today's spike in volatility and drop in the market was due to a poor number in the CPI, well, I got another number coming for you out tomorrow, and it's the producer price index, or the PPI. Mm-hmm. And if that number is poor and reflecting potentially higher inflation than most people want to see, I think we've seen it everywhere. It's just a matter of, right now it's coming into the numbers. We could see another shellacking tomorrow, and we could certainly see the VIX spiking up over 30%.
Now, chart number 2 is looking at the Nasdaq. Obviously, the growth trade has been leading the way down, and days like today sort of complete or continue that trend. Walk us through your chart of the Qs here. Right.
So I think when we broke down at the beginning of May, and you can see that this index fell below the 20-day moving average, which is the dotted line. I use the Bollinger Bands with StockCharts, and we could see that fell hard and gapped lower the next day, and it struggled to recover. And you see Monday, it barely missed tagging that 20-day moving average. It fell hard. I'm sorry, that's Friday. On Monday, we fell hard, and then we tried to gather ourselves yesterday. And then if you look at today's action, you can tell that that was just no good. It bounced off of the it hit the ceiling at the 100-day moving average, which isn't shown here, but it's a 100-day moving average, which was sitting at around 323, Dave, and then rejected right there, and then we've closed near the lows of the session today. It's just awful, and there are lots of targets down there. Obviously, the 200-day moving average, you can see there, is clear. It's about 203.02 or 302.5. Not a lot of air down there. There's not a lot of support until that area, and you think, well, boy, that's another 6-7%. Well, a lot of these stocks, Dave, in the index have corrected more than that. So I wouldn't be surprised to see this fall. And the funny thing is that, as I told you earlier, the Dow Industrials were leading the way on Monday. It was up 300-400 points. It ended up down, and it was pulled down by the Nasdaq. The Nasdaq, look at that red bar on Monday. It was awful, and it pulled down all the indices with it. So this is something that happened back in March, and you can see the big correction that happened in March, and now we're below the 50-day moving average succinctly, and it's going to be it's going to push a giant boulder up the hill here. It's going to be tough. This is not the time of year that you want to be long tech stocks or risk stocks, especially with the Fed probably going to be coming into some sort of a rate hiking mode soon. And then, when interest rates are going up, that's bad for tech stocks.
It's a great take, Bob, and I appreciate your comment there, thinking about the seasonal trends as well, right? We're at that point where growth names tend to underperform May through October, and so far May is following through as expected on days like this. Bob, thanks so much for joining us today. Thanks for bringing a couple charts that put things into proper context. Stay safe. Congrats in advance on the next step you're taking on your wedding coming up soon, and be well. All right.
Thanks so much, Dave. It's great to talk to you. Talk to you soon.
That's Bob Lang. Bob's the chief options analyst at Explosive Options. And it's interesting when he's showing the chart of the Qs, you can see these clear signals, right? And that's what that's what strikes me on some of the charts that we've looked at. A day like today, if you're surprised by it, I think you've missed, like on Bob's chart of the Qs, things like the MACD sell signal, the Chaikin money flow turning negative, RSI rolling over, breaking down of price support, failing at a Bollinger level, a Bollinger band. These are all indications of internal weakness, indications of support that's not holding, right? Indications of negative sentiment and negative flows, and certainly I haven't seen anything on a day like today indicate that we're done with this sort of move. It certainly gives you the impression that this is the beginning of something further to come. So interesting, by the way, the comment at the end there about this is not the time to be looking at growth names. And we're in that seasonal part of the year. Thinking of my conversation with Sam Stovall a couple of weeks ago, sort of the May through October timeframe is really bad for growth stocks. Usually has been, and usually it's best to go into defensive sectors, things like utilities, or be in cash. And so far, May is following through on the sell in May phenomenon. It is working just fine this year. Our next segment is called Banking on Breadth. The goal with this segment is to focus on the breadth conditions. These are fluctuating in real time, as much of the market is. A lot of our breadth data updates during the day, some of it updates after the close, after we're able to record the show here. So some of it will be updated real time. I'll point those out. Things that are a little delayed, I'll point out because they could change if you're looking at the charts later tonight into tomorrow. But overall, certainly a day like today is going to make the breadth conditions evolve very, very quickly. What's interesting about the breadth conditions leading up until this week is that they've been resoundingly positive across the board. And I think, last week where you saw the cumulative advanced decline lines making new all-time highs across the board, large caps, mid caps, small caps, all making new highs. That shows you that, again, in general, the market's working. Things are okay. This is changing very quickly, and these are not updated for today's distribution. The advanced decline lines are down a bit yesterday. I think you're going to see an acceleration to the downside when we update today's numbers, looking at the distribution and the broad declines. And overall, I think these can come down quite a bit. What will be interesting on all these, the 50-day moving average is indicated on every one of these charts. If and when they break their 50-day, which could come as early as today for something like small caps, that starts to signal a rotation lower. These advanced decline lines, by the way, have been above their 50-day moving average for the most part completely since last October, last November. This is as the S&P kind of came out of that congestion area, made a new swing high and moved higher. All of these made a new high as well, got above their 50-day. A couple of them kind of tested it there in January, but bounced very quickly after a day. That would be sort of the first line in the sand there. Now, particularly on today, the question for me is always, is it a 90% down day? And that is, are 9 stocks out of 10 down in the course of the day? Now, to be honest, there are a number of different ways that people like to measure that. The way that I tend to look at it is just looking at advancers and decliners as a percentage of the total stocks on the NYSE. There's some other ways that people do it. Some look at it in terms of volume, which we'll focus on here in a second. But overall, I'm seeing 87% of the NYSE listings down today, 13% of them up. That's close enough for me to think of it as a pretty broad distribution day. And why that's important is if you look back at when we've gotten 85 to 90% down days, they're in corrective periods. It's not just a brief, it doesn't just happen in the middle of nowhere during an uptrend. That is a broad distribution where pretty much everything's going down. That happens more in consolidation phases. The last time we've had a number this low is back in February, which did not get above 85%. The last time we've been to almost 90% is in the September and October period of last year. So all of a sudden, this market is quickly looking like some other corrective patterns. That can mean you can have quite a pullback in terms of price, also a correction in terms of time. Remember, markets can correct one of two ways or both, right? Price, time, or both price and time. And so I think navigating that is going to be a function of looking at the charts, looking at key levels, but also looking at individual names and groups and how they're doing. Let's continue on here. The next chart is looking at the percent of stocks above their moving averages. As of yesterday, we had 92% of the S&P above their 200-day, 76% above their 50-day. Those are probably going to come down fairly significantly today, particularly this one, the stocks above their 50-day. I wouldn't be surprised if that comes down pretty well. Now, this remaining above 50% in general is sort of the back of the envelope are we okay gauge, right? As long as at least 50% of stocks are above their 50-day, that means overall things are holding up pretty well. What's interesting, though, is this is coming off of an extreme high level. Here in early April, you had about 92, 93% of the S&P above their 50-day moving average. That's down already to 76%. That's going to go out lower. You go further down from that, that's a lot of stocks that are not able to hold their 50-day moving average, just like the S&P is just beginning to try to do this week. So I think that indicator would be a very interesting one to watch to start to assess how deep and how painful might a pullback actually turn out to be. It's interesting. This is looking at new highs and new lows. All you can see is green because we've had an incredible number of new highs. On May 10th, which was on not yesterday, but Monday, we had 45% of the S&P making a new 52-week high, which is one of the highest readings in a long time. Yesterday, it was a handful, and today you will have a little less. You probably have some stocks making new swing lows. We'll have to see. 52-week low is pretty far away for a lot of for most stocks. So most likely you'll just see an evaporation of new highs. That expansion in new highs has been one of the bullish inputs, right? One of the bullish indicators has been an expanding list of new highs. All of a sudden, if that goes away, not as helpful. Finally, I just want to point out in terms of Brett, the bullish percent index, which is still above 70%, that holding above 70% keeps it in bullish territory. It breaks down through 70%. That's called a bear alert, where you have to start to question, this is stocks registering a sell signal from the point and figure charts. So as that may happen through the course of this week, that would indicate a little more negativity. Other one I just want to throw out very quickly, the McClellan oscillator back below zero. That below zero is based on moving averages of accumulation distribution using the advanced decline lines. That being below zero basically tells you distribution over accumulation. I am not surprised to see it below zero and would expect that to continue to remain below there for the foreseeable future. We need to wrap the show, although I feel like I have an endless list of charts we could look at to diagnose this downturn. We need to wrap. This is the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the percent of advancers decliners. In our segment Banking on Breadth, we focused on this. Now, we usually look at the cumulative version of this, where we're looking at advancers decliners over time and seeing how those trends are evolving. But it's also really helpful to look at it on a day-to-day basis. One of my mentors, Walter Deemer, often shares on social media his take on up down days and all that. He is big on 90% up days and 90% down days, and I learned a lot sort of following his work on how he analyzed those. I tend to have a little more wiggle room than most on things like this. So if it's above 80%, I start to look back at historical corrective periods. Right now, you could argue it's very similar to the pullback we have in January or in February to March. We've kind of done that same thing. A quick pullback of about 5% that comes to the 50-day, that was January. We go below where we're at. All of a sudden, I'm starting to look back at other analogs, things like September, October of last year as more of a drawn out corrective pattern with more pain that needs to be felt. So that's a good chart to watch through the remainder of this week. Second, and this has been one of our 3 and 3 a number of times in recent weeks, it's looking at the ratio of offense versus defense in consumer. This is the ratio of the XLY versus the XLP, the consumer discretionary versus consumer staples ETFs. At the bottom, it's doing that same ratio on an equal weighted basis. Both of these are really close to breaking down, and another down day on a move away from offense into defense is going to signal a broad negative signal, a bearish signal from a key sentiment indicator that I use. This looks at basically flows from offense to defense in the consumer space. It has been positive for a long time. The cap-weighted version has been a little less positive because of the overweight in things like Amazon and Tesla, which have been struggling. But in the equal-weighted version, it's coming off as well. Today really accelerated this to the downside. We're really close to making a new swing low, which would indicate investors are really getting defensive. Finally, on a day like this, I just want to remind people there are always stocks making new swing highs. Perigo came up on the screen for new 13-week highs today, making a new move above its 200-day moving average. So if you get overwhelmed by stocks in risk off mode, there are always stocks breaking out. Look at changes in your scooter rankings and screen for stocks making new swing highs. Folks, that's our show for today. Thank you so much for joining us on a day like this to make sense of things. Thanks to Bob Lang from Explosive Options for giving us his take on the NASDAQ. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.